probably heard you should sell puts to generate passive income. And most people, they choose the strike price of the put they want to sell just by guessing. Now, I've created a three-part system that's worked for me over the last 20 years, and let's talk about it today. A lot of traders choose the strike price by just using their gut, and this leads to them getting assigned or panicking and buying back that put that they sold for a loss. If you've been trading long enough, you know exactly what I'm talking about. I believe that strike price is where a trade is won or lost, and that starts at the very beginning of the trade. You know, I've been doing this for almost 30 years. Today, I'm gonna share with you a really quick example of where choosing the right strike price. Let's look at the stock of PayPal. You can even see I put a little crying emoji with an arrow on my chart where I was feeling the pain because I knew that I would want to come back and look at this later on. I didn't think about sharing it with all of you guys out there on YouTube, but let's talk about it today because this trade turned out to be okay, but the strike price and the selection that I chose, it didn't work out at first, and it's hard to hang on when a stock is going against you. Everyone's talking about how bad a company is. I think almost everyone knows about the stock of PayPal, but at one point when I drew this little emoji on the chart, people were talking about PayPal going out of business. And when you have a position in a stock and other people are talking about it going out of business, it's never, ever a good feeling. So let's talk about this trade. Let's talk about what I sold, how I chose my strike selection, and how did it work out. So PayPal had a beat on earnings, but the stock was down. You can see almost 8% at market open. So I thought to myself, stock is trading at 70. Let me sell some 65 puts. So right here, I'll sell 65 puts. My put was actually in the money by the end of the day. You would think good earnings, stock is going to be good. So the stock continued to drop an additional almost 10% from when I sold that 65 strike put. To put this in context, before earnings, PayPal was trading right here at 75. By the end of the very bottom, it was down 20%. Now, we're not talking a long period of time. We're talking about 2 to 3 weeks here. These are daily candles. You can see PayPal was in pain. I was feeling the pain right here. Looking back thinking, what if PayPal continues to go to zero? Now, you can see this is historical. And you can see that PayPal came back, but it wasn't as painless as it looks on the chart because it never is in the past. Now, if I had gotten shaken out and I had sold my PayPal for a loss, how do you think I would feel when PayPal returned right back to 75 here in July? So did I have to hold through, May, June, and July? Yes, I had to hold my shares. I had to be careful about how I sold covered calls. If you haven't seen my last video on when I sell spreads versus covered calls, if I had only sold covered calls here, I would have again capped my upside and I would have lost on the downside and lost on the upside. So you can sell spreads and you can make additional money as the stock recovers. In this particular position, if I had lost on PayPal and I saw the stock bounce in the next 3 months, I would have felt pretty horrible. And I'm sure that if you've been selling options long enough, you might be in the same situation. That's why I have 3 simple steps of how I choose my strike selection. Let's talk about it today. Let's make you some money and let's keep you from emotional trading. The first thing I start with is I go to the options chain and I look at the delta. Now, we can get really complex about delta as a Greek, but the thing that I love the most about delta is it's an easy way to calculate your probability of profit. Let's take a look at the stock. Right now, Bank of America is trading at $54 a share. We can see here on the chart, Bank of America is trading at $55 a share. We're going to round up just a little bit. We have some moving averages here. I have a little pyramid drawn on my chart, but there's a moving average right here around 52. That looks like a decent area to sell some puts. Right now, Bank of America is trading about $55 a share. We're just going to round down slightly. Let's hop over to the options chain. And if you don't know what an option chain is, it's going to look a little complex at first, but I promise it's really not that difficult. So if we go to the next monthly expiration closest to 45 DTE, so days to expiration, these options expire on March the 20th, right here on the screen. That's 42 days from today. So when I look at the delta, I can tell you a delta of 28 means this option, if we sold it, is going to have about a 75% probability of hitting profit. Now, delta measures the speed that an option travels? In this particular case, we can use delta as a probability of our assignment. So I target between 20 and 30 delta. That means if I sell a 20 delta put, I have an 80% chance that that option is going to expire worthless. If I choose a 30 delta put, it's a little bit closer to the money. It's going to move a little bit faster. There's a 20% chance that option is going to expire worthless. If we're selling options, we want them to expire worthless. So the lower the delta, the safer your assignment risk is. The further away from the money is. The higher the delta, the more the option is going to move, the more risk that comes with that assignment. If you're selling a 30 delta, you still have a 70% chance that option expires worthless, but you collect more premium for more risk. So less premium, less risk. More premium, more risk. It's up to you how you determine your risk. I like to go between 20 and 30 delta. That is the sweet spot for me. In this particular case, if we look at the 28 delta, it is right out of the money. You can see here, our probability of profit is 74%. Now, if you're like me, you set up your target of 50% GTC for each one of the puts you sell, and you can see it's an 87% probability that this option expires worthless. If you go to that 16 delta, which is about as close as we can get in this particular example to a 20 delta, you can see our probability of profit has moved to 85%. The first step I do in my three-part system is I check the delta for my probability of profit, which gives me a rough idea of my assignment risk. Now, the second thing I do all the time, talk about in almost all of my videos, is I look for support and resistance level. I love to go out to the weekly chart. Let's move from the daily to the weekly chart. You can already see I have some lines down here. I love to draw lines at support and resistance levels. You can already see very clearly, I hope, where an additional line needs to go. Now, I haven't added it on my chart because I wanted to talk about it here, but you see we have resistance here, resistance here. We have some resistance. It went a little bit past it, right? Then it bounced, it came back. Do you see how this resistance became support back in September? So I would put a line on my chart right here at 48. Now, Bank of America has had a really nice move. You can see I caught my second level of buying the stock here at 34, and it's moved all the way up to 55 really quick. So I don't have any additional lines here. If you wanted to add some lines, you could definitely add. You have some resistance, the support became resistance. I know it went a little bit beyond. You could definitely put a line right here on your chart around 53. I think if you combine step one of delta between 20 and 30, and you can find some support and resistance on the weekly chart, and you can look at the daily chart as well. We have a moving average here at 49, so around 50. Hop over to the daily chart, get yourself a little bit of confirmation on multiple time frames. That's even better. You know, we were talking about selling some puts down here at 50, which is pretty far away. I think if I were to sell a put today on Bank of America, it would have to be closer to the 5250 strike, which is up here. The 5250 strike is right in here. And we do have some support previously. We have some support in this area as well. So on the daily chart, that trade makes sense. Now, the third step in this system is determining, do I want to own this stock at this level? I don't know. You need to figure that out before you get in the trade. It's not just about the premium you receive. It's not just about, is there support and resistance? Now, the premium you receive and the delta and the support and the resistance, these are all cases to make you feel more confident, because trading is 95% emotions. When I was holding on to PayPal thinking the company's going out of business, it's not a good feeling. I don't care what anybody says online. It's not a good feeling. So the third step is, am I comfortable owning Bank of America at 52.50? Now, you're going to collect a little bit of premium, so it's going to be closer to $51, $52 with the premium that you collect. This is going to be about a 5% decline in the stock. So I'm getting paid to buy a really quality bank at a 5% discount. For me, that's an easy trade. I know how this works. I would take this trade in a heartbeat. I calculated my break-even price. I know what this company does. I see their support and resistance here, and I know that the delta is in my favor. Let me show you another quick example of how I choose strike price based on post-earnings trades. Let's hop over and look at the stock of Qualcomm. Now, Qualcomm reported earnings. You can see here they had a double beat and the stock was down about 9% pre-market. I decided to go ahead and sell some puts on this. And I posted this in my community. Now, what I'm talking about here, this is for educational purposes only. I'm not encouraging you to take any of the trades that I take. I just want to teach you what has worked for me over the last 20 years. So I posted in the Discord community some Qualcomm 130 February puts, and I collected $235. You can see here, I sold the 30 Delta put. So that means since I sold the 30 Delta put, we know there's a 70% chance this option expires worthless. Now, I chose the closer expiration because if this got tested, I would just roll it out to March. Now, in agreement to buy 100 shares of Qualcomm for the agreement to buy 100 shares of QCOM at 130, I got paid $252. That's a good risk to reward considering that the stock was down on a double beat. I never got tested. It looks like this trade is going to close today. It's gapping up. This is a great example of how I trade in real time. I can make the decision in a couple of minutes with a 3-part system. What's the delta? Is there support and resistance? And do I want to own this stock at this level that I sold the put? For me, it was yes to all 3 of those. It was an easy decision and I will be paid in one day. Strike selection is your critical line of defense. And that's something you make at the beginning of a trade. If you're not confident in your strike selection, you're likely to shake yourself out of a trade at the worst possible time, watch the stock bounce and go against you, and then think that the stock market is rigged or for someone else. Listen, the stock market is not rigged and it's not against you. The stock market doesn't even know who we are. You need to have a good system like I just talked about today. Simple 3-part system to make sure that you're confident in your strike selection. So when you set up a trade like we did today, set up a trade like either in Bank of America or QCOM, when you set these trades up, you're confident in your strike selection. So you're confident in your trade because it sucks when a trade goes against you. I'm not going to sit here and tell you it doesn't suck, but these 3 steps, they're going to keep you in the trade longer. If you like this video, like and subscribe it. I have great content coming out every Thursday just for you.